Hello, everybody, and welcome back to the Raw Selection Private Equity Podcast. Today, we have another Playbook Series landing in your phone or whatever device you're listening on today. So this is a Playbook Series, and I'm very pleased to welcome back Adam Coffey. I'm going to try and introduce with the amount of titles he's had and has currently. So Adam, for those who haven't listened previously, has been on the podcast, I think, twice now. He's a proven private equity-backed, multiple exit chief executive. He's currently an operating partner, a consultant, and also a best-selling author. And I'm sure there's a load of other titles that we can add into there. But I'm really, really pleased that Adam's joined us, and he's going to be sharing all about today, about building a business to $1 billion, which is something he has achieved in his career. So Adam, there's your introduction. Thank you very much for coming back.
Alex, thank you for having me. Hello to all your listeners out there. So I'm a three-time guest. Am I the first three-time guest in the history of your podcast, potentially?
You are the first three-time guest.
I like that. It's a first. So good to be back, Alex. Good to see you. And hello to all your listeners out there.
Absolutely. So for those that want to listen to any of Adam's previous podcasts, which do promote both his books as well, and we're going to talk about a third today as well, but please do check back in the podcast sessions, and that will give you a further insight into Adam, and we'll also see what he was doing previously, which was leading a business to $1 billion exit, and currently we'll explore a little bit about what he's doing, in particular, a recent big, or today release, actually, although this isn't going to be going live on the day that it will go out. But Adam's got a new book called Empire Builder that he's going to give us a little bit of an insight in today, which does talk about building a business to $1 billion.
Well, thank you. I'm glad to be here. You are literally the first podcast I'm doing in promotion of the new book. So I'm coming back to an old friend for a new book launch. Third time's a charm. Let's get this going.
Well, thank you very much for that, Adam, and appreciate you to joining us on the podcast. So, Adam, why don't we kick off with giving a bit of a format around building what you've done previously to build a business to $1 billion, and then, or at least your experience of that, and then let's drive into how the listeners can replicate that.
Sure, I'm happy to do that, and that's really what this book is about, and it comes from statistics. Just here in the U.S. alone, there's 33 million small companies. Of those 33 million small companies, only 7% ever achieve $1 million in revenue. Only 4% of those ever get to $10 million of revenue, and literally on the entire planet today, there are only 3,000 companies that have over $1 billion in revenue. And so it seems like it's just so hard for entrepreneurs to get business right. And my book really was designed to try to help break down those barriers that are key to success at the different levels, kind of the first million, the first 10 million, the first 100 million, and then finally the journey from 100 million to $1 billion. And a lot of entrepreneurs might get surprised when I talk about that particular segment of growth and what my recommended activities are on how we actually make that happen. So the world has so many small companies, so few large, big ones at the top, that I just felt like there was, after 35 years of being an executive, 21 as a CEO, I just felt like it was time for me to share what my own thoughts were and secrets about how an entrepreneur, regardless of whether you're a startup, you're an established company, you're a PE-backed CEO already, and you're in the middle market, you're trying to find your way. It's like there's a lot of lessons that I've learned across my career that I want to use to be helpful so that others don't have to make all the mistakes that I've made in my career. Good Lord, I've made every mistake there was. I wish somebody had written my books and I had a chance to read them, back when I was starting out in my career. So really, Alex, my goal and mission in life today, having rotated out of the CEO seat a few years ago, is to help other entrepreneurs be more successful, regardless of what stage they're at, kind of in that evolutionary development of their companies.
Excellent. So where does it start, Adam? What's the foundations? What does a business need to do in order to start building towards that $1 billion revenue?
Well, so Alex, as a part of my empire building, I'm also a buy and build guy, which means I bought a number of companies. I actually completed 58 acquisitions building those 3 empires. But I've looked at hundreds of companies, and now as a coach consultant, I've literally looked under the hoods. I'm looking under the hoods of hundreds of businesses per year, and almost universally, what I discovered was the reason most companies never get out of the gates, they never get to $1 million of revenue, they never get to that 10 million mark in revenue, is because they struggle to get their unit level economics right. And so I always tell people, look, you want to build $1 billion business? Before you can do that, you first have to build what I'll call the perfect $100,000 business or the perfect $1 million business. And if you can make it work small, then scaling is just a mathematical formula. And at different sizes, there's different activities that we embrace to get to the next level. But I tell entrepreneurs, and I can't tell you how many times in my career entrepreneurs have told me, geez, Adam, when I get bigger, I'll figure out how to make money. I'll figure out how to get profitable. And I'm like, no, wrong answer. What we need to do is figure out how to get really good and profitable small, so that when we're scaling, success is a foregone conclusion. And so in the beginning, it's all about unit level economics. So what does that mean? Well, take a landscape maintenance business as an example. Someone who takes care of your garden, and comes weekly and mows the grass and trims the bushes and does all that kind of stuff. And if you think about that, the unit level economics is one truck. It's one crew. If I think about a product-based business, it's one product. If I think about a real estate investor, it's one multifamily housing. If I have a multifamily housing building, it's one door, revenue per door. My expenses are cost per door. If it's a single family home rental, then it's my cost per single family home rental. We have to understand, first of all, what is our unit level economics? And then how do we perfect it at the smallest level possible, get it profitable? I have a rule I call the 30-20-10 rule. I need to generate at least 30% gross profit. So my revenue, my cost to service that revenue, whatever I'm doing, I need at least 30% gross profit. I need to keep my SG&A, which is my back office expense, lower than 20%. And my minimally acceptable profit, at the bottom is at least 10 cents on a dollar. And if I can figure out that formula small, then success in scaling is a mathematical formula. It's simple, easy to follow. So that's where I think most entrepreneurs who are just starting out go wrong. That's where it goes south. And then they waste the one thing, Alex, that we can't buy, and that's time. They spend too much time trying to perfect something that just isn't working. And then they wake up 10 years later and wonder why they were never successful. So to me, small is about getting unit level economics dialed in so that I can build a formula for success.
Okay. So 2 questions that have come from that. What's firstly is what's next, but also where this comes before is growth eats cash. How do you continue to go from 100K to 1 million, from 1 million to 10, from 10 to 50 to 100 to 1 billion? How do you manage that when you have to consider the fact that growth eats capital, if you agree with that statement?
Well, I do agree with that statement, but there's so many different formulas to success. So now I love service businesses. I'm always around. I'm building service businesses, not to sound sexist, ladies, but it's guys, trucks, broken stuff, guys, trucks, building things, guys, trucks, doing things, on a job site for people. And so what I love about service businesses, Alex, is that they don't require the same level of capital intensity to build and to start out. So let me compare and contrast 2 different businesses. If I want to build a $10 million service business, and I talk about this in the book, the mythical $10 million landscape maintenance business, I'm going to need 52 crews, 52 trucks, 52 lawnmowers, 52 weed whackers, 52 blowers. When I look at all of my capital expenditures to do that, it's going to be about $1.3 million in capital required to build a $10 million revenue business. If I compare and contrast that, though, that same $10 million business is throwing off $1.5 million in free cash flow, $1.5 million in net profit. It's literally a less than 1 year payback on the capital. And so it's very capital efficient. If I think about a real estate business where I'm going to have a bunch of rental properties, how much money will I need to invest in order to generate $1.5 million in free cash flow? Hint, the answer is a lot. It's going to be $30 to $60 million worth of a real estate portfolio. And I'm going to have massive amounts of debt that are required to build the same cash flow from that business. So I'm a big firm believer in services. I love services businesses by their very nature. They're not capital intensive. Free cash flow and net profit are generally one and the same. Our biggest expense is typically buying vehicles. And so going out and doing something for a living is what we specialize in. So the reason for my 30-20-10 rule is because I need to have that minimal level of cash profit and cash flow so that I can be reinvesting in my business as I'm growing that. And what I typically do is I'll build a mathematical formula. So I perfect the unit level economics. And in this example, it's about 198,000 in revenue I can generate with that one landscape maintenance crew. And then I've got a certain level of expenses that I have to cover, and I'm going to throw off a sufficient amount of gross profit, and that gives me the cash flows that I need in order to scale the business. I build the formula to get the first $1 million right, and then I can build the same formula to get to 10 million. And as I'm going from 1 million to 10 million, mind you, a path that very few businesses actually succeed in achieving in life. So God bless you to all those out there who have more than $10 million in revenue, and you're the founder and you created this thing. But as you're going on that journey and you're scaling up to that size, you're also creating operating leverage. Buying 52 trucks is cheaper than buying 5 or 6 trucks or 1 truck. And so as we're getting bigger, if the math works small, the math actually starts to improve as we're growing. And as we're growing, we're now throwing off more cash flow, which I can then use to reinvest. And so if I need capital, so many sources on the planet to get money. And I hear this often, I really do. Entrepreneurs think that their biggest hurdle to success is raising capital. And I tell them it's really not. The world is filled with capital. And so if we need capital, we just need to know where it's at, how to treat it, and how to go get it. And so in a small business kind of environment here in this country, we've got the Small Business Administration. They have programs that banks use to loan money to entrepreneurs and small businesses. I can go to private equity, to family offices. I can bring in friends. I can leverage my own banking relationships with my local banks. So many different ways to get capital. My brother and I once bought an insurance agency. It cost us $4 million to buy. I had the owner of the agency, who was in his 70s, hold back $1 million note at 10% interest. I borrowed $2 million from a family office. So we borrowed 3 of the $4 million required to buy a $4 million revenue insurance agency that we paid $4 million for. And only $1 million was equity. And so my brother and I brought in a couple of friends. It was really for his benefit. And we all together came up with, call it the $1 million that we needed in equity. We borrowed $3 million. The company itself had $1.7 million in free cash flow, per year. And in about a 4-year period, we used the cash flow of the business to pay off the debt. And we then owned it for 15 years. We grew it. We kept distributing money to ourselves. And when we exited, we sold it for 12 million. Not huge numbers, given I've had $1 billion exits, but in terms of multiple of invested capital, it was huge. So I tell entrepreneurs, if you can figure out the mathematical formula to run a good business, the capital that you need is going to be embedded either in the company you're building or the company that you're buying, and or then through just the readily available commercial sources for capital. We can solve for capital problems, and capital should never be the reason that you're not successful in building a successful empire.
Excellent. So as we go we've hit that kind of 10 million mark and driving and using the unit economics you've mentioned, what's that growth from I know it's a big jump, but what's the growth from 10 to 100?
So what I love about this is, as you're building that $10 million business, in my book, I talk about making strategic pivots. And so adjacencies, the magic in any business is the customers that we have. It takes us time and effort to generate a relationship with this thing we call a customer. Once we have them, what else can we sell them? And so I talk about this mythical landscape company. And so I'm cutting grass. And as I'm going from 1 million to 10 million, as soon as I cross the 1 million mark, I make my strategic pivots. And maybe now, instead of just cutting the lawns, I start doing mulching in the beds. I start doing holiday lighting in the holiday season and helping people put the lights up on their homes. I start doing sprinkler repairs and winterization, and depending on what the climate is where I'm at, a lot of these different ancillary services that let me sell more than one product or service to a customer. But when I'm going from 10 million to 100 million, in most cases, most industries, I'm going to oversaturate the market that I've started in. And I'm going to start thinking about replicating the magic that took me from 0 to 1 million, million to 10 million. And I'm going to go now and do that in a couple adjacent markets. I want them close enough to where I can surge the resources I've got to these new markets to help out if we need it. So I don't want them to be on another side of a continent or another side of a country. We want them close. We want to build a region and take advantage of this density that we're creating. And I tell people, on that journey to 100 million, most entrepreneurs encounter what could be their first exit. And so in my mythical business here, this landscape maintenance business, as I think about EBITDA, or use net profit, as a proxy for EBITDA for those who don't understand earnings before interest, depreciation, amortization, and taxes, all that stuff. But think about, if I need, if I'm going to sell my business, kind of with private equity, there's two natural exit points that come up. First is at about 4 million of EBITDA. So at about 4 million of EBITDA, I can expect to have a big population of real private equity firms that have actual funds, real limited partners, and they're looking for something to buy in the lower middle market. And they're going to be the group and companies that take, companies from about 4 million of EBITDA up to about 10, 12 million. And they're going to sell them upstream to a PE firm that goes from that level up to, say, 40 to 50 million of EBITDA. And this is where there's a lot of activity. So if I'm building a business, I'm a pilot. I never take off without knowing where I'm going. I have an exit plan from the beginning. And so I'm thinking, as an entrepreneur, my first potential exit's 4 million. My second potential exit's up around 10, 12 million of EBITDA. And if I get to 4, I can sell that service business for, just round numbers, many different industries, around 7, 8 times. So I've got 4 million of EBITDA. I could get a $32 million enterprise exit. But if I keep doubling down, keep working hard, and I'm opening up adjacent markets, I'm building a region, and I'm going to 10 million of EBITDA, now I'm looking at an exit that could be $100 to $150 million, depending on what industry I'm playing in. And so I'm getting to a 9-figure exit. But here's the shocking thing, I think, Alex, is what I tell entrepreneurs in my book. An entrepreneur should never seek to build a billion-dollar business alone. We want to bring in sophisticated partners. I believe really strongly, especially in today's world, which is so volatile. We need to be prepared for volatility in our lives. We need to get diversification of our wealth. And so for Forbes, not too long ago, I wrote an article called the Law of 130. I created this law. You take your age as a 2-digit number, and you take your percent of net worth that's tied up in your illiquid company, this thing known as your company. And, for a lot of entrepreneurs, that might be 70, 80, 90% of my net worth is tied up in this illiquid thing called my company. And as I get to a certain age, when those two numbers added together equal more than 130, I think entrepreneurs need to get asset diversification so that they secure the future for their family. I want them to do a partial exit, and potentially give up control, now work with a private equity backed sponsor. And now I've got money out, but I'm a rollover investor. And now, as I'm going up towards that $100 million in revenue business, or from there and beyond, I now have partners. I'm using their capital. I'm using their debt relationships. And about every 4 to 5 years, when they sell, I get another wheelbarrow full of money that I can go hide in my backyard and bury it in the garden. And then I can turn around and start, make another rollover investment, and I can do it again. And when I think about my empire that I spent the most time at, commercial laundry company that I built. I had 3 different sets of shareholders. I was there for 13 years, 4 months and a few hours and a few minutes, whatever it was. But I actually got 5 bites of an apple over a 13-year period. And it's like, anytime I build a spreadsheet for an entrepreneur and I look at, okay, here's you running your business and you run it for 10 years, 20 years, and then you sell it. How big was it? What'd you get for it? Versus picking your exit point, either at 4 million or 10, 12 million of EBITDA, now bringing in a partner, getting multiple bites of the apple about every 4 or 5 years, map all that out over a 20-year period. I guarantee you that you will wind up making more money by bringing in a partner and accelerating your ability to do growth by doing things like buy and build and going out and buying. One of my empires, I put 34 companies together. Another one, I put 23 companies together, and I needed hundreds of millions of dollars, which I wouldn't have had as an entrepreneur. And so the PE firm comes in with their equity, with their debt relationships, and I'm able to climb that pyramid towards that billion-dollar exit much, much faster when I bring in institutional capital to work with as a partner. So I think it's get it working small, scale it to the first million, perfect it, add some ancillary revenue streams, go to 10 million, open up adjacent markets, in create a region, and take that up to somewhere between 30 and 60 million in revenue, and then make your exit and bring in the partner and now continue to ride, and now bringing advanced tools to bear like mergers and acquisitions and, building that professional leadership team. And in doing those things, I learned how to go from being an anal retentive control freak as a small company to being the conductor of the orchestra that's now orchestrating massive growth on a large scale. And I think that's how entrepreneurs really can accelerate their own wealth creation in a shorter period of time versus just trying to build a billion-dollar business all by themselves.
Makes sense. Just bear me 2 seconds. I'm just going to, my light's about to turn off. I've got automatic lights in here. Kian, if you can cut that bit out, please. But we're about to lose our light, which would have been no use. So if we've got that private equity capital, we're looking at that growth or the external capital, whether it's private equity, family office, etc. Now, obviously, that's where your main piece of experience comes in of scaling those businesses and those multiple exits. What are the kind of top 2 challenges that you've experienced during that scaling period that you've had to come over that's like, do you know what, Alex, you're going to go through this, you're going to go through that. This is what I did to mitigate that challenge, that risk. That
I'm going to give you 3, and just to make sure I get them all covered so I don't forget. When I'm thinking about, there's going to be a people component to this, and so let's make sure that we talk about people. But I need to make sure that I understand and know what good looks like. And then I need to be really judicious, on the buy side. And I'll even add in a 4th, which is the integration component as well. But so let's start with all of this. As I'm getting bigger, as I'm growing, I'm going to need people. We're going to go through growth. First of all, growth is messy. Growth is not neat and orderly. If you're looking for neat and orderly and you're an empire builder, I got news for you. You're not going to be successful because growth is messy, especially the kind of growth that I'm talking about, where you're buying 20 or 30 companies and putting them together. It's tough work to grow, and it's messy. So get used to some disorganization and some, the train's going to go down the tracks, but as you're coming up to the turn, it's like, you're going at a right pace when it stays on the tracks and doesn't fall off, but it's on the hairy edge of falling off. And so growth is coming quick, and we're going to need people. We're going to need people who understand what big looks like, and they've got probably an increased skill set versus some of the people potentially that started with us on this journey. Some people have come along the entire way, but there'll be times where we need to upgrade talent, or we've created new positions because of growth. We've created new layers of management. We have to go out and find these people. And so I tell people, don't hire for the company you have today. Hire the skill you need for the company you will be in 5 years. And the reason for that is we're growing so fast. that literally, if I'm growing at a 30+% compound annual growth rate, my company's going to quadruple in size in 5 years. Well, I better have if I'm hiring key talent, I can't hire for the size I am. I'm going to hire for the size I'm going to be. And these people will be reaching down, rolling up their shirt sleeves and helping us get up there. But at the same time, they also can then stay with us as we go on for the next 5 years. So they start fighting below their weight class. Eventually they end up above their weight class, but we're going to need talent. So we got to solve for talent. But number two, we have to have really sound strategy, and we need to understand what good looks like before we ever start a buy and build adventure. And I think too many times PE firms just want to get deals done, or companies want to find, entrepreneurs, founders, let's just go buy stuff, and I'll figure it out. I'll put it all together. That's where you get into trouble. We need sound strategy. We need to have good filters, I call them, to understand before I ever look at anything, what is good going to look like? How would I describe the perfect company to acquire? And then when I'm building the M&A machine that's going to help me go out and build a funnel and evaluate companies, I really need to know what good looks like before I start buying. Otherwise, I fall victim to what I call shiny penny syndrome. Everything looks good. I overlook every flaw. And I can tell you that one bad acquisition can derail a management team for years, literally. I once did a bad acquisition. Mind you, I inherited it. I didn't actually buy it, but it was being bought when I was coming in the door. And it was less than 5% of my revenue. And it probably cost me about 80% of my management headaches for the first 3 years I was at this company. And so it does not make any sense to buy anything less than a great company with a good market reputation and pay a fair market price, because buying a bunch of small companies at fair market price is going to be a low multiple. And as I assemble them and get bigger, I'm going to get rewarded with a much higher multiple. And that arbitrage is the profit and shareholder value creation that I'm really going to key in on. And that's going to be the important part of my future strategy and how I generate the profits and returns for my shareholders. So buy good companies, know what good looks like. That's another component. And then finally, on the integration piece, we need to make sure that when we buy a bunch of companies, that we are very thoughtful around our most important asset, which is our people. There's how fast I can move technically and how fast my culture can absorb change. And so I need to be mindful that the most important aspect of any empire is the people within it, that actually are doing the work. And I need to be judicious and thoughtful around the people component as I'm assembling companies and integrating them and putting them together. I need to be thoughtful and a good steward to those employees. And if I can do that, if I can solve for the people I need as I'm growing, if I'm thoughtful about what I'm buying and putting together, and then I'm thoughtful about how I'm integrating it, if I can focus on these three key areas, knowing that whoever my sponsor is, their responsibility is give me the checkbook that I need to make, these purchases happen, then I can grow really, really fast, really, really large. And as a co-investor, investing alongside of the private equity firm, and when these entrepreneurs are staying and we're building an empire, and they're rollover investors alongside me and the PE firm, we all benefit from the arbitrage of getting bigger, selling for a higher multiple. We sell for more because as we get bigger, we become rarer. Again, only 3,000 companies on the planet with over $1 billion in revenue. And so as we're getting bigger, we're worth more. And we get the fruits of our labor from having assembled a bunch of small companies. And if we do all of this correctly, we can really build a large empire in a short period of time and climb that pyramid and get to that $1 billion exit place, which I've been blessed to find. And it can be a wonderful experience. And on that day when that company trades and I walk around at headquarters and I see all these smiles on faces as people, who became millionaires for the first time, and those who've already been in the club, got another big payday and they're smiling too. It's like, these are wonderful times. And in every company that I built and ran, I believe I built a really strong employee-centered culture that cared about people, that was not driven by profit, but driven by the fact that profit creation was going to come from building a strong culture, getting an engaged workforce, and then letting that workforce help you achieve, and then giving them a piece of that action as you were growing and climbing the pyramid. And all of that is kind of the key, I think, to getting it right.
Excellent. There's quite a bit to unpack there. If we start with the talent piece, how do you know if somebody's going to be a good fit for the business?
So there's a guy out there named Sandy Yog. He owns a company called CEO.works. And, when I first met Sandy and looked at his system, so I've always been a GE guy, an initiative-based strategic plan guy. And even so, what Sandy's work did was then take strategic planning to a different level. What are the initiatives that we're going to work on? That's pretty common and amongst all types of different strategic planning systems or management systems. But then now let's translate that to who in the organization is going to do the work. My last empire, I had 3,000 employees, but we identified 22, I think it was 22 people at the last hold period who were going to be responsible for generating almost $2.5 billion of added shareholder value. Now, the other, 2,980 employees or 78 employees, still very important because the company has a base trajectory that we have to maintain, and we've got to take care of our customers and do the right thing and take care of our employees. But when we're talking about bending the growth curve and getting to somewhere new, it's like that construction project of actually bending the growth curve is done by a small handful of people. And so Sandy's work really revolved around identifying what the key skill sets were, and so it's not just I need a VP of sales because I'm growing and I need a VP of sales. I'm doing a buy and build, and I'm going to buy 20 companies, put them together. And I'm going to have salespeople from 20 different cultures, and I've got to blow all this up and rebuild it and get all these people singing this from the same hymnal. I need someone who's got the experience doing that, please. Can I have some of that? And then I call up somebody like you and I'm like, Alex, it's like, here's my unicorn hire. If I could find a person with this skill set, they would be such a perfect fit versus just telling you, I just need someone who's been a good VP of sales. They may have been a good VP of sales in a software company that was growing at 50% a year, never did any buy and build, never had to blow up cultures and rebuild. And it's like, and that person, although their numbers would be great, high probability they would fail in my buy and build environment because it would be the first time they're experiencing that. And so I think it's really analyzing when we need a person, what is the specific skills that are required for the specific work that we are doing, over that 5-year hold period. And how do we best define that so that when you go looking for talent, you've got, a good scorecard and a good idea of exactly what kind of talent we need in the organization. And when we pull that part off, we get people right more than we don't, so our probability of success in making good hires and hiring good people that last and get the job done, much, much higher if we think of it in that framework.
Yeah, I think that gets missed too much of looking at the nuances and what's different about the business. Completely agree with that. And then if I look at another challenge for private equity backed businesses is they can find add-ons, but they cannot integrate them as well as they'd like. So you mentioned the talent piece to bring that in, but aside from talent, what needs improving? How do you overcome that?
Yeah. So again, great question, right? So there's a couple questions that we have to have before we start looking. Do I have a scalable platform? Are the systems I have in place, will they allow me to do an integration? Because if my base company that I'm starting with is a jumbled pile of goo and a mess, then trying to integrate something into my mess is just going to make it messier. And so do I have a scalable platform? Assuming I do, well, then I would still say that most people have a day job. And I believe strongly in actually hiring project managers and integration people to work in the business to help us as a full-time job, help us get integration right. And so that, in my world, as I'm building an M&A process, I've got the deal teams up front, maybe a buy-side advisor that's filling the funnel and I'm looking for opportunities. I've got a deal team that's working them. I get to LOI, I get into diligence. It leads to a closed deal. But I bring the integration managers on right about the time where the LOI is signed And now they're parallel processing with the deal team. Think of it like a baton toss, in a handoff in a relay race. And so they're running side by side. And when the deal closes, deal team peels back off to the front. Integration, manager continues on with the project until it's integrated. And then they cycle back, pick up another one. And so I've got these two people working together. One peels off, and then this one comes back and meets back up again. I can't make my fingers do that while I'm looking at myself. I won't get the synchronicity right, but it's an orchestrated, almost ballet. And so I believe very heavily in using tools like very detailed Gantt charts and having dedicated resources to get the deals done, dedicated resources to do the integrations. We have to ask ourselves, are we ready to do full-scale integration? And if not, then don't force it. Let's do integration light. Maybe there's an operational need. I don't want to fully integrate businesses that I'm buying, but I need to integrate the back office. I need to integrate HR and payroll functions and accounts receivable and payable, whatever I can, I'm going to integrate. But let's identify what that level of integration is going to be. Let's Gantt chart it out so that, the engineer in me feels satisfied that we've got a 3,000 step plan. And then I've got people whose dedicated job is to own making sure that every one of these steps happen. And they'll have to pull on resources that do have day jobs, and they just have to be distracted for 10 minutes, help them get a task done. They go back to work, but the integration manager is the continuity. And I think a lot of times where integrations go south is we don't put enough time in the planning stages while we're negotiating the deal and going through diligence so that we really understand what the nuances are of each business. And we haven't done a good job. And so we wake up one day, it's closing day, and it's like, now what? Well, who owns the integration? You got it. I got it. No, I got a day job. Sorry. It's like, we really need to be thoughtful about these things in advance. When we are, then we have a much higher probability of success.
So we've got to that $1 billion exit. You've been there. What did it feel like for you, Adam?
So a huge accomplishment, right? And probably no more of a feeling than it is for an entrepreneur who went from startup to 4 million of EBITDA and then sold and got their first payday at 32 million versus my payday at $1 billion. It's what does it feel like? You have a sense of accomplishment. And a sense that it's like winning a championship, in the Premier League and or the World Cup or in the North America, winning the Super Bowl or something. It's like there's a big feeling of accomplishment, but it needs to be short-lived because whoever just bought you and paid that $1 billion or even paid that $32 million exit, they're expecting you, no matter where you're at on that continuum of size, after you celebrate for a little bit and look at your money in the bank account for a little while, eventually it's time to get back to work and to now with your new partner, engineer, the next 5-year hold period and a successful outcome for them of which you get to participate. And so it's like, I use a lot of sports metaphors in my books because the feeling is really much like, it is like there's a lot of good applicable sports analogies. You win a championship in a year, the first thing you have to do is go back to spring training if you're in baseball and start over again. And you haven't won any games the next year. And so you constantly have to just be gearing mentally up for your next championship run. Where people get into trouble is when they start to check out thinking, well, I just hit the home run. I just won, the cup. I don't need to do this again. And that's where it goes south. That's when some PE firm's calling you, Alex, and says, I'm going to need a new CEO here. This guy's checked out or this lady's checked out. They're just, I gave them a bunch of money and they think the game's over and my game's just starting and they're not engaged. And so I need to do something. So, the feeling of success is great, but there's a real strong need to dig back in and then do it again and again. And again,
yeah, you definitely the private equity way is certainly there, Adam, and I know you've done it multiple times. So, Adam, how does anybody get in touch with you? And secondly, how does anybody get a hands on your third book?
So, all my books, Amazon pretty much globally, but anywhere books are sold, you can find my books. And I'm on LinkedIn every day. People can find me there. I actually respond. I don't have a team of people culling through my messages. I get a lot, so be patient. And sometimes I'll miss a message or two, but I respond to all my messages. And so there's adamcoffey.com is another place that you can go. Between that, LinkedIn, Amazon for my books, or wherever books are sold. I think that's the best way to engage with me. And I really appreciate, all the people around the globe who've helped make me a #1 best-selling author twice. I haven't checked lately, but, high hopes for the third book that we get there soon. And thanks for having me on, and thanks to all your listeners for hanging in there.
Well, thank you very much for coming on, Adam, and thanks for writing yet another, no doubt, fantastic book. And I'll definitely be getting my hands on it. So really appreciate that. And as always, thank you very much for everybody joining us and listening in today. Should you ever need private equity professional, hiring, or portfolio executive, please do reach out to us at Raw Selection. And if you haven't already done so, please do subscribe to the podcast, and you'll be notified of the next podcast that comes out every 2 weeks. But till the next time, keep smashing it, and thank you very much for listening. Adam, awesome as always. Thank you very much.
Thank you. I appreciate it. Thanks for having me on.